Welcome, everyone. Welcome to and we do this twice a year, although obviously I'm talking about the markets constantly, especially these days. But twice a year, two of our 12 monthly events, maybe is the better way to put it, are market updates only. And that's not to say if you ask a question that veers into a different topic slightly that we can't get to it. Of course we can. But today is going to be all about the markets and the economy, and not just where they're going to go or where they might go, because of course nobody has that crystal ball, but also taking a little bit of a look at where we've been, because one, that does tend to help us inform our opinions about where things are going to go. But two, it's also just helpful to take stock of what has gone on. And in this case, we actually have a lot of positives to talk about as we look backwards. We'll see if some of those positives can stay the case as we go forward. But thank you all for being here. I'm gonna talk for just a minute because I know everybody it takes a second sometimes to get logged on, or Zoom messes with you or something like that. But if you have any questions throughout this presentation, you can type them in the chat. You can type them in the Q&A. You can well, those are the third option is you can even raise your hand digitally. There's a button that says raise hand. That allows us to unmute you. Now, I might not get to those questions if you do have want to actually verbally ask a question. I might not get to that till the very end, just for time's sake. But feel free to type in the chat as we go along here. Um, I will, if Aaron will point them out to me if I don't notice them, and I will make note of, ooh, I'm about to answer that here or whatever. So use that functionality. Now, for those of you who might not know me, and again, I know most of you do, but my name is Anthony Gerbi. I've been with Stein Financial Group here for more than a decade now. And this is always a presentation, this topic, that is near and dear to my heart because my degree is in economics. So really, at heart, this is the stuff that I'm really conversant in. I mean, obviously, all the stuff we talk about on a daily basis, of course, but my schooling was in economics. So I am ready to dive in, as many of you know, to the deep end. Hopefully, not too deep that it alienates any one of you, but I am ready to go there. So today is the time when I kind of get to unleash and say, "Great, let's talk about the meat and potatoes here." And my goal is, as always, to let if you take away one thing from this that you're like, "Oh, that was interesting to hear," that I've succeeded as far as I'm concerned. But two is to make sure that what I'm telling you comes through and makes sense and doesn't just sound like somebody talking over anyone's head or anything like that. Everybody we work with is actually pretty sophisticated on this, but my goal is to make it as digestible as possible. So, a quick look at the agenda here. What happened in 2025? That's where we'll start. Why did it happen that way in 2025 is sort of the second piece of that. Where does that leave us right now? And then the big question, the one that all of you probably care most about. Okay, what's going on in 2026? What are we looking ahead to, good or bad? So let's go back to 2025. Now, this is on the left what some of the major banks predicted for the stock market in 2025. And don't get hung up on that number too much, that 6,500 or 6,628 or whatever. That's just what is a measure of the index. And let me explain what the index is. Thankfully, there's a little blurb up in that top right that explains it, but that uses all of the fancy jargon that I get to read every day, but hopefully you don't have to. The S&P 500 is basically a combination of the 500 largest stocks in the US stock market. And the reason we lean on that so much for some of these metrics is the theory and I would agree with this. As the S&P 500 goes, so goes the entire market. It is a barometer, in other words. So you could use the Dow. The Dow was kind of the more classic one. The Dow I don't use as much, not because it's bad, but purely because the Dow is only about 30 stocks. The S&P 500 is about 500. Now, more doesn't necessarily make it better, but I want a little bit of a bigger sampling there. And there are, of course, many, many other indexes, as they're called, which is just a grouping of stocks that's meant to tell a bigger story. So don't worry about this number in terms of what the number itself means. That's just a, a number that's generated from the value of all those stocks. What we care about is whether this number is going up or down. Because if it goes up, that means we're making money or the market's making money. If it goes down, it means we're losing money. Okay? And you can see that other than Deutsche Bank last year, the estimates for where the market was going to go were off. They were significantly short of where the market ended up. So as of December 31st, the market ended up at 68.45. Only one of these banks was actually even within, 150-ish points here, which was Deutsche Bank. Now they overshot slightly, but there was a lot of pessimism last year, and that's what I'm trying to get at from this slide. And I was going to look up, since I've got it up in front of me. As of this minute, I'm looking at the S&P 500 right now, and it's having a down day today, by the way. It's been kind of up and down the last few days. It's at 68.60. It's literally changing in front of my eyes. 68.66 right now. So a little bit up from where it ended the year at. But why was everybody so pessimistic last year, other than, again, Deutsche Bank? These institutions, I don't think I have to tell you this, are obviously not using crystal balls here. They are making estimates. If you were paying attention to the news last year, and this article came out in the midst of the tariffs that were announced last year, and we'll get to tariffs because obviously if you've been watching the news, there's been some tariff news lately. But on April 5th, 2025, so just a little under a year ago, in the midst of the tariffs, this was a headline. Global brokerages, and I don't remember which site this was off of. I think it might have been Reuters. Yeah, I think it's Reuters. Anyway, this was a common headline. Global brokerages, raise recession odds. JP Morgan sees a 60% chance of a recession. 60% chance of a recession. Now, you didn't miss it. There was no recession last year. We didn't even get close to a recession last year. And by the way, while this headline was out there, and if you were talking to me, I would have told you I don't see it. All last year we were saying, and this is not me just tooting our own horn because we can be right and wrong. I'm not saying we knew, but I did not see a recession last year. Far, far from it. We certainly there were things to be concerned about, and this was right in the midst of when those tariffs were announced and the market was really having a tough time then, and that's not nothing. But this was a very pessimistic headline, and there was a very pessimistic time, and it was all wrong. It was all completely wrong. It's not even that there was a kernel of truth to it. It was completely wrong. And so anybody, myself included, who tells you they know what's going to happen, I think most of you already knew this, they can't know what's going to happen. You can be right about what's going to happen, but a lot of times that's an educated guess and a little bit of luck, frankly, is what a lot of that boils down to. So that's a good table setter as I'm about to tell you what I think is going to happen going forward. So let's take a look at last year, and this is actually going to be instructive because it kind of dovetails into this year. So this is the S&P 500 again. So what happened over the 12 months of 2025. So it starts the year over here all the way on the left. And, there's a few important dates circled, although, does Inauguration Day make a difference to the market? No, it doesn't. But just to orient ourselves around the year. So Inauguration Day, April 2nd is when the new tariffs were announced. That was the day that President Trump stood outside in the Rose Garden, and I think they had like a flip chart up there that was like a grid, a spreadsheet basically of tariff this country, tariff this country, tariff. And the market did not like that. And it's not just that the market didn't like the tariffs themselves, although I think that was definitely part of it. It was the how all at once it was. It was obviously we knew some of these tariffs were coming, but it was the speed and the ferocity of some of these tariffs. And that's what caused that big spike down in the markets between April 2nd and April 9. It was a week. What happened on April 9th? I know that bubble's not circled here. But on April 9th, that was when the White House came out and said, you know what, we're going to put a pause on this for another 60 or not, it might have been 90 days. And we're going to give everybody a chance to kind of, one, calm down. Two, maybe we can get some of these negotiated down. And at the time, if you talked with me at the time, this is what I was saying. The announcement of these tariffs was meant to be, in my opinion, a big flashing sign above the White House that said, phone lines are open, come make your deal, to the other countries around the world. And the problem with the messaging of it was they just said, well, let's just put them on and then they can negotiate them down. They realized a week later that what they should have done was said, hey, this is what we're planning to do. Come negotiate them down. Okay, so the market likes that much better and things recover pretty quickly. This was also a time period, and this is going to dovetail into something for this year, that they first floated the idea of, hey, can we remove Jerome Powell, the chairman of the Federal Reserve? Can we just remove him? And the answer, by the way, is not without like cause that not just that he's doing stuff you don't want, but that he's actually incompetent at his job. And he remains in that job until later this year when his term is up. We'll get to that. And then there were a couple rate cuts. There was a government shutdown. If you've heard us over the past few years when we've had these government shutdowns don't tend to impact the markets all that much. In fact, the last couple times the government shut down, the markets have gone up. I know there's that little blip right after that bubble, but that really had nothing to do with the shutdown. So overall, despite I've hit on some key points there, and we had a little bit of a hiccup with those tariffs, last year was a good year. I mean, this chart is up. This chart is up and to the right. Yes, not straight up and to the right, but it'll never be like that. There's always going to be something going on. Looking back to last year, one of the big things that drives the market is how much money the companies in our economy are making, their earnings. And if earnings go up, you expect the market to go up. The prices of owning that company should also go up in tandem. Now, it's more complicated than that, but the general relationship does hold true. So ignore the big spikes in the middle of this chart. That was COVID. Obviously, there were big spikes down when the shutdowns happened and then big spikes up a year later when everything was compared to a low number. But just compare it to 2023 and 2024. We've been in pretty good shape earnings wise. And I think if I were to take one step back, and this is maybe the right place to do it, looking at 2026, there is a lot of nervousness out there. And you're hearing about nervousness on an individual side, but you're hearing about, okay, companies are laying people off. Target just had layoffs. Cargill had layoffs. Many companies have had layoffs. How can you be telling us, and I know this only goes to the third quarter of 2025, it's not to today, but this trend has continued. How can you be telling us, Anthony, that companies are still making money? And the answer is both of those things can be true. This is just earnings, not necessarily profits. Now, profits have been okay too, and I don't need to do a whole digression because it's different for every company. But what I can say is companies in the US are making money. They are also being, whether it's by their shareholders or just internally, being very cautious about how much costs they're carrying, and workforce, unfortunately, is one of those costs because of external factors like interest rates, like tariffs, like just the global economy as a whole. And so, despite the fact that this chart is in a good place, that doesn't mean things are great, but it also doesn't mean that other bad things are happening, that things are bad. I've found that this period of time, this is where I'm kind of going with this, has so much mixed data out there. And not to, obviously, this data affects real people, if we're talking about layoffs or something, and I don't want to discount the human element of it. But if we're looking at it from a big picture perspective, you can look in one direction and see, wow, that's actually pretty good. And then you can look at another direction and say, ooh, those numbers aren't that good. What's going on there? And there's a lot of mixed messaging right now. So how do you make sense of that? That's what we're trying to do today. Overall, we expect the economy to be growing. We actually just got fourth quarter growth numbers, and they were a little bit less than expected. In fact, I'll tell you, because when this presentation was created, it was they were still estimates, and the estimates were a little high. So the economy grew. They were expecting, close to 5% in the fourth quarter. It grew by only 1%, which is much lower than expected. Now it's still growth, and that I think is the key. If you look at the headlines, and for those of you who want to look at all this stuff, consumer sentiment, um, inflation, unemployment, all that stuff, these numbers are not bad in any way, shape, and form. And by the way, those unemployment rate and that inflation rate, those did come in at that level. So those numbers are right. It's just that top one with the asterisk that was came in lower than expected. The economy is growing, which is what we want. Now, it's not growing as fast as maybe we would hope it would, but it's still growing, and that's something. The unemployment rate is, fluctuating, but it's still relatively low. It's not zero, it'll never be zero, but it's low. Inflation is not too bad. I'd like it to be a little closer to 2%, but frankly, for all of you who have done financial planning with us, we estimate that inflation in the long run is going to run 2.5%. Well, we're right in that ballpark right now with where it's actually been for the last year. And so all that stuff on the surface you're looking at it, I would look at it as putting my economics hat on and say, yeah, pretty good. Not bad. Not perfect. And it's never going to be perfect, but not bad. And so why this fourth line here, the one that intersects with my head on the screen, why is this consumer sentiment index, which I know many of you might not be familiar with? This is a survey that is done by the University of Michigan. And it basically just asks people, how do you feel about the economy? How do you feel about the markets? Just emotionally, basically, going forward. Good, bad, somewhere in between. You see where we started the year, 64.5. It goes up to 100, by the way. And we're at 52.5 right now. And don't think of that as like, well, 52.5% of people are blah, blah, blah. It's just a number that's boiled down from the responses. So higher's more optimistic, lower is less optimistic. Well, would you be surprised if I told you that 52.5 is one of the all-time lows of that survey going back to the 1970s? It is lower, this sentiment index right now, than it was in 2008 in the middle of the Great Recession. Now, I just told you the economy's growing. I told you unemployment's not that bad. It's right around where we kind of want it to be. Inflation's just slightly higher than we'd want it to be. How can people be so pessimistic that, and I'm not scolding anybody. This is a rhetorical question. I'm getting to it. How can people be so pessimistic that they're thinking right now is worse than 2008? And it's a couple things. One, it's the political situation. Now, I'm not making any judgments on the political situation, but the media feeds the narrative that the political situation bleeds into the economy or over controls the economy. And while I would agree that absolutely politics plays a role in economics and how our country grows, financially speaking, how the markets perform, it is a huge minority of what actually causes growth. You and I are 70% of the economy, going out and doing and living our lives and spending money and buying things and making things through our jobs if we're still working. And so the government has a much lower impact than one the media would allow you to believe, or frankly, the government would want you to believe. Because every election cycle, it's the same story, right? We're the party that knows how to fix the economy. Well, for better or worse, the economy is so much bigger than that no political action can fix or probably wreck the economy by itself. It can contribute, but it can't do it by itself. This is my opinion. But that sentiment is so low that if I was going to take it, and I don't think this chart, I've been showing some of you, if you've been meeting with me, a different chart. It's not in this presentation, so I'll just describe it to you. Of that survey, of that 52.5 over here, that's what I'm referencing, by the way, next to my head. If I were to tell you, hey, I have a new investment strategy for you. I am going to use only this consumer sentiment number to decide when we should invest in the market or not. And my goal is to say when the consumer sentiment is high, when everybody's happy, that's when I want to get out of the market because that's when everybody's getting greedy. And when consumer sentiment is low, that's when I want to get into the market because that's when everybody's scared and maybe I've got a good value there. If I were to only use that signal, the 12 months period historically after you hit a relative low point, which we've just hit just recently, the market averages up 24%. And that goes back to the 70s. There's actual data behind this. So relative lows were pandemic, 2008, .com. They basically track whenever we've had a big recession and a few other times too. But if you hit a low point, the market averages up more than 20% over the next 12 months. So if that was my signal and I'm looking at this number right now, I should be screaming on here, buy, 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 buy. And I'm not doing that. And this, again, I'll get to that in a little bit of why I'm not doing that. And vice versa, if we were at a high point, the market averages like 3% over the next 12 months if you're at a relative high point, which we're not. But that signal right now is kind of screaming buy at us, buy the market. The market's going to do well here. And I bring that up because, again, there are mixed signals from other signals that are telling us don't buy right now. So how do you make sense of that? That's what I'm here to help you do. So if you've gone to one of these presentations before, we always have, I'll try to get out of the way here, a slide like this, which is, this is put out by a financial firm called City National Rockdale. They run investments and they put out these speedometers. And green is good, red is bad. And it breaks down the economy into all of these different factors, right? And this, right, what you've got on the screen right here is January of 2025. So January of last year. This is where the year started. Now, really, the only things, now, despite the fact that everybody was predicting a recession, really the only things that really were flashing warning signals were the markets were high. That's that equity market valuation and geopolitical risk. And I'll be honest with you, geopolitical risk has been red for like 5 years in this. And I think it's going to be as time continues because that's just the world we live in now. But everything else was okay to good. Okay to good. This is, by the way, why I was not predicting a recession last year. Some people were, I was not. There was not one, to be clear. By June, though, so from January to June, halfway through the year, okay, so we have the same two red ones there, and now we've got a lot more orange ones. A lot more, it could go either way. This is kind of the mixed messaging that I'm talking about. Well, there's some good things about the labor market, there's some bad things. Let's flash forward then to January of this year. Well, it's actually corrected itself to a large extent. Actually, they put the geopolitical risk back to orange. I would kind of disagree with that. There's always a new problem cropping up, but at the time this was created, I think it would have been fair to say that. And the only thing that's flashing at us is, ooh, the markets are high right now, and that sometimes makes you wonder, if they're high, should I be buying when they're high? That's kind of the thinking. But everything else is okay. And that then dovetails. I'm going to skip this chart because I think we've already talked about that. That dovetails into what we're predicting for this year. The fundamentals right now are fairly good. And by fundamentals, I mean I'm talking numbers. I'm talking inflation, unemployment, the stuff I nerd out about. Now, there are things that are pushing against us, right? Inflation. I'm going to talk about that in more detail. Could that become a bigger problem than it is right now? Yes, that is probably the number one thing we're watching, and I'll explain why in just a little bit. Stock valuations. The stock market is way up, but it's partially up because of all this money being pumped in on the promise of AI. Technology companies have really seen the brunt of a lot of these increases, the AI companies themselves. And, it would be fair, and I've done this myself, although I'll caution you, I'm not saying history is going to necessarily repeat itself, but it is fair to compare this AI boom to the dot-com bubble. I believe that is a fair comparison. If you remember, the dot-com bubble of the late 90s, early 2000s, followed by the bubble bursting and the market dropping significantly, was all about the internet. It was all about the promise of the internet. What's the internet going to do for the economy, for businesses? It's going to change everything. It's going to make everything so much better. And I want to tell you, all of those opinions, I mean, I'm sure not all of them, but the majority opinion there, the internet's going to change everything. This is going to be huge for business. That was correct. That was right. Now, what was wrong about it was how fast it was going to happen and exactly how it was going to happen. That didn't really sort itself out until after that bubble had already burst. But the opinion was right. And that we could be very well in a situation where that's true of AI too, where AI is going to change everything. AI is going to be in every product. It's going to make it so much more efficient. I'm taking the optimistic approach right now. Obviously, there's a pessimistic approach too, but let's just devil's advocate here. And it's going to, and let's just say it's totally possible that that optimistic projection is right. Okay. But how quickly is it going to be right? That's probably what matters more for the markets. And so this sky high growth that we've seen, can that actually be justified by the companies turning this promise into fruition? There's a chart that kind of goes into that. Labor market weakness, that's an econ jargon term. Weakness. What does that mean, Anthony? Well, weakness would be there's layoffs happening. Maybe the unemployment rate's ticking up by 1/10% or two. Not wholesale a ticks up, but something, and that's worth paying attention to. Geopolitical, obviously, that's going to be an ever-present theme. Now, I will say, none of the current, geopolitical tensions that are kind of dominating the headlines, and I'm not afraid to name them. It's Iran, obviously, and that's been in the news most recently. But Russia, Ukraine is still happening. There's still a lot of tensions in the Middle East outside of Iran, even though Israel and Palestine and Gaza has died down to an extent. I don't want to say it's died down, but it's not at its fever pitch that it was. Venezuela, don't forget about that. That just happened a couple months ago. Now there's Cuba. There's all this stuff going on, and yet none of them, with the possible exception of Venezuela, and I'm not a military person. I'm not a geopolitical person. This is me reading the market's reaction to it. None of those items do I think will have an impact on our markets, even if they develop a little bit beyond where they are now. Now, if they escalate into something that's global, then yes, they will. But so far, we don't see any of these geopolitical, or the ones that I just named, as that's going to put a dent in our market. That's going to make a difference for your investments on a daily or weekly basis. That's, just a prediction. There's no guarantee that that's right, but I think that's where we're looking at right now. And then lingering uncertainty from a government shutdown. Obviously, our government is going to continue to be at odds as we get further in. Don't forget, this is an election year. So I think it's only going to get more standoffish as everybody postures, at least in the House, for their reelection campaigns. So that'll be fun, won't it? What's going to go well for us this year? Global trade. Okay, this might be a good spot to talk about tariffs because I imagine that's one of the questions a lot of you have on here. If you've been watching the news, the Supreme Court just struck down, would be one way to put it, the tariffs that the administration had levied back in April and then delayed and then re-levied later in the summer, and that's what caused the market to sell off, blah, blah, blah. They just ruled a lot of those, or a big part of those, were not allowed to be put on by the administration. You declared illegal, or they just weren't allowed to do it, whatever you want to call it. So that is an interesting variable to throw into this mix because what happens from here? Now, the White House has already said that, well, we're just going to throw a blanket 10 or 15, I think it changed depending on the day, whether it was going to be 10 or 15% tariff on every country thing, because we're not allowed to kind of pick and choose. That was one of the things they ruled against. So we're just going to do it on everybody. That to me is just they're gonna do that just because that's the extent of their power, and they want to throw their influence around one more time. I don't think there's a real economic justification for that. I think they're just like, well, you won't let me do this, so I'll do that. But tariffs being reduced, because in a lot of cases, this, even though they'll keep some tariff on there, tariffs being reduced should actually help to lower costs. Now, notice what I said there. I said it should actually help to lower costs. I used the word costs. I didn't say prices, did I? And that's because traditionally, once a retailer has raised the price, they're usually not going to cut it unless they really have to. So whether this reduction in tariffs then means, oh, hey, some stuff's going to get less expensive again, I wouldn't hold your breath for that. I'm sure some things will. Maybe like cars, big ticket items where they really do compete on price. But I bet there's a lot of stuff are going to keep the tariff pricing they put in and just keep it on because they're like, you'll still pay it. And I'm not trying to pick on any business in particular. Now, I will say there are some businesses like Walmart and Home Depot, for example, that the data show have not yet actually passed on all their tariff costs to us, to the consumer. That's an interesting idea because it's like, well, they've been kind of eating it to an extent for the last 9 months here. What did they do? Did they raise prices anyway and say, well, we got to make up for what we lost? We planned on raising prices because we thought these tariffs were going to stay, and now they're not, but we were planning on it, we're still going to do it. Or did they say, okay, it was, we ate it for 9 months, our balance sheet's still fine, let's just not raise prices and we'll still be, on the low end. I don't have an answer for you on that, but that is a decision they are going to have to make. But other places, they already raised prices. So will they fall? No, I don't think so. I think a majority of them, if they can get away with it, will keep it. And how do we know if they can get away with it? Purely if people are still willing to pay it. That's the whole ball game. If you're still willing to pay those prices, they'll keep them. And that's how the economy works. But I say all that, and that might sound like a pessimistic take on this. It's fair, but the end result is actually lower tariffs should mean inflation doesn't go up as much as we were maybe thinking it would. That could be a good thing. That could actually be something that allows us to continue cutting interest rates, and the Federal Reserve factors into all of this in a minute. That's monetary easing down here on this bullet point list. But that probably eases a little bit of pressure. So this was kind of a nice little variable that was thrown in, I think, economically speaking. Let me. Okay, this is where I wanted to go. So I'm glad this is the next chart. And then I think it's going to go to the next section. Perfect. Okay. Here, now I talked to you about that consumer sentiment number, and I said I don't have that chart in here, but some of you have seen it. I've talked about it before, and I painted the picture hopefully well enough that you can understand it. Here's the other chart that I think you should know about going into 2026. We're now in 2026. Valuation measures. Now, I've been showing this to almost everybody I've been meeting with lately. So if you haven't seen it, I apologize. Maybe it just didn't come up with what we were talking about. But this is a measure. The first thing I tell you, don't worry about any of the numbers on this screen. Look at the line. Just worry about the line. This goes back to 1994. So the bottom axis is the time, is in years. This is a measure of how, quote unquote, it's a little more complicated, but this is how I want you to think about it. Quote unquote, how overpriced the stock market is. Okay? And what it's really measuring, to get nitty gritty for a second, is what is the price of a stock versus how much money they make, right? So as that ratio gets out of whack, as the price goes up but they still make the same amount of money, this line will go up. And it wouldn't make sense for this line to be insanely high, right? This stock is worth $1,000 a share, but they make $10 a year in revenue. Like that wouldn't make any sense. And that's an extreme example just to illustrate the point that doesn't actually happen. But where we are at right now, I would like you to look compared to the 90s. The last time, and I'm going to take COVID out of this because this other spike right above my head right now, that spike right there, drop and then recovery, that's COVID. That's stimulus. There were a lot of weird things going on then, obviously. I'm going to take that out of the equation. So, barring COVID, the last time this line was as high as it is right now was 98 through 2000, which was the dot-com bubble. So if you're looking at this, and I'll use the same example I did before, if you're looking at this and you're saying, I'm going to use one chart to invest, Anthony, and by the way, I don't recommend anybody do that, but just the thought experiment. If you were going to do that, you would say, this chart is screaming sell, 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 right? This is saying the market is as overpriced as it's been in the last 30 years. And the last time it was this high, when there wasn't a global pandemic, was right before the market tanked for 3 years in a row. The only time it's ever tanked for 3 years in a row. Tanked maybe that's not a technical term, that's my term, but dropped, gone lower for 3 years in a row. So, what I just told you, the sentiment tells us it's a buy, buy, buy. This signal in a vacuum is telling us, I think, sell, sell, sell. How do you make sense of that? That is our challenge for 2026. And I'm going to tell you in just a second a story of how I think 2026 will go. But the last thing I want to point out about this is notice this line is ticking down on the very right side. It's starting to come down. And what I've been telling people, and this is why I'm not coming in here and being doom and gloom and saying, look, I'm pessimistic, let's bail out of this thing, is there are two ways to make this line come down, come back to its average. One way is for the market to drop. That's the way we'd prefer it not to happen, okay? Which is just, hey, the price of the stocks can just go down. That's a market drop. The other way that this line can go down is if companies start earning more money. And essentially what this line is telling us is that there's a big bet right now on AI. And the AI companies need to start making money to justify the amount of leverage or the amount of bet that's been put on them that they're going to make that money. Well, actually, in a short window of time, I'm not saying this is necessarily going to hold up. A lot of these AI companies are starting to make more money than they were before. For example, NVIDIA or NVIDIA, I don't know which they prefer, the chip manufacturer. And the chips are a huge part of AI because that's what powers the computers that run the AI, and all the processors and blah, blah, blah. NVIDIA, in its latest earnings call, which was like more than a month ago now, they beat their earnings expectations fairly significantly. So in other words, the market thought, hey, we think you're going to make this much money for the last quarter. They beat it significantly. That is another way, if that trend were to continue, for this line to come down without the market having to drop. So I don't want to make this seem like, well, this is an obvious answer, Anthony. What this graph says is gospel and you should just be working off this. No, it's always more complicated than that. So all right, I'm going to put us on just a blank slide and put myself in the middle because now I get to tell you a story. And it's a story a lot of you have heard me tell. But the thing, and there's not a slide for this, which is why I'm just kind of telling it to you. Here's what we think about 2026 going into it. I don't think right now that 2026 will be a bad year when we look back on December 31st. I don't think so. However, I think there will be a period this year, and it could be very short, could be multiple months, could be multiple quarters or halves of the year. Well, if it was multiple halves, it'd be the whole year, but a half a year, where the market could be down and could be down somewhat significantly. And I'm talking like a 20% decline, which, by the way, is what happened when tariffs were announced last year, was just a very short 20%. But I think that's totally possible, plausible for this year. Here's why and when I think it would happen. Okay. Now, this is my opinion, educated, but still ultimately a guess. To start this year, if you've talked to me about this, we have said, hey, we think it's going to be a good start to the year, actually. Now, it's actually been a little up and down. It hasn't been bad, I would say, but it's been up and down. But the reason we feel like it's going to be a good start to the year is it's going to be a big tax refund season. Okay? This is the first time you've heard me mention taxes. And how are taxes playing into this? Well, if you remember back to July of last year, the big, beautiful bill that was passed, it had a lot of tax provisions in it. And unlike most tax bills, it applied a lot of the tax changes to 2025 itself. Now, a lot of times when you pass a tax bill, you do it for future years because you're trying to get somebody to, you're incentivizing a different behavior. Hey, do more of this. We'll give you a tax break. I could make up a million examples, but I think you get the point. But they applied it to 2025, which was already half over by the time that bill was even passed. They added some new deductions for it. For example, anybody on this call over 65, and if your income's under a certain threshold, you get an extra $6,000 per person, per if you're a couple per person that are both over 65, in deductions on top of your standard deduction. Did you know that? If you filed your taxes, you might know that already, but if you haven't, you'll see that. If you have a preparer, they should mention it or at least know about it. And certainly, like if you use TurboTax, that should have it all plugged into it. And so that's a deduction that we didn't know was going to be there to start 2025. That is there, that is added now. And so that's going to increase refunds. In fact, I think the latest estimate from the IRS was that the average refund could increase by as much as $3,000 per person. Or maybe that was per couple, but 3,000 was the number. Now, that's big. Now, by the way, that doesn't mean you're guaranteed a refund. Obviously, everybody's situation is individual. If something else changed, that could totally change your variable. So I'm not promising that to you. But in the aggregate, that's what's being expected. Now, think about that with me for a second. Why would they pass a bill retroactively, essentially, that half the year is already over, that would increase refunds? Did that happen by accident? And they're like, I guess that's going to happen, but whatever. Look, I'll be cynical for a minute. It's an election year. This is a stimulus check. That's what this is. That's what this tax bill, not the whole reason behind it. I don't want to go that far, and I don't think that. But I think that was, if we change the taxes like this, it'll essentially be a little stimulus check in the first part of the year when everybody files and gets their refund. And I think that's what we're going to see as people really start to file. Now, obviously, some people have already filed, but really, March is when filing really starts to pick up because tax documents are out there, all that stuff. So if there's a stimulus, oh, and by the way, next month, our next event is going to be on the tax bill and all the updates to it. And obviously, 2025 is already over, so you don't have to wait to file your taxes because there's nothing you can do about 2025 anyway, other than a couple little minor things. But for 2026 going forward, we'll have all that info for you. So watch for that invite. If you'd like us to get you registered, there'll be a poll at the end of this where you can just say, hey, pre-register me for that. But that'll be our very next event. Little digression there, sorry. So back to my story. So essentially, tax refund season is going to be a stimulus check this year for a lot of people. Not everybody, but a lot. Well, I've been comparing that, economically speaking, to a sugar high, right? Sort of like when we got the stimulus checks coming out of COVID. And that was to serve a purpose. That was because everything was in the dumps from all the shutdowns and we had to build it back up. But we're not in the dumps right now, right? We're in a fairly decent economy that would be my terminology for it. So if anything, I think this is just going to top things off and make it look even better for a short window. For a short window is the key. But that's why I've been telling everybody, hey, stick with this through tax season. Barring something unforeseen that comes up, stick with the market, stick with what you've got through tax season because you might as well ride that sugar high if we're anticipating one. But the next thing you should be thinking about, and this is what we're thinking about, is okay, sugar high happens. What happens after a sugar high? Well, a crash. And don't you that word, I don't like using that word because I don't think the stock market's going to crash. But what is the cost of that sugar high? Well, let me paint a picture of what I plausibly think it could be. All of a sudden, we've got a little bit more money in our pockets, right? Now, the tariff stuff that I talked about, I had anticipated prices were going to start going up more because all these retailers that hadn't passed on costs yet, they're going to be like, now's the time to do it. Everybody's got a little bit more cash. But the fact that the tariffs were struck down kind of throws a little bit of a wrench into it. But I still think, in general, after a stimulus check, we tend to see inflation go up. Which is just to say we tend to see prices go up. You got more money floating around out there. You can afford as a retailer to raise prices a little bit because people will still pay them because they have a little bit more money. That's the basics of it. Okay. So, okay, maybe inflation starts to tick up a little bit. Well, what does that mean? Well, that means probably that the Federal Reserve, who has been cutting interest rates, not nearly as fast as Donald Trump wants them to cut interest rates, but that's another thing. But they have been cutting slowly. The only way they can keep cutting is if inflation stays low enough, because every time they cut interest rates, that helps inflation go up, actually. And there are reasons why they cut, and that's why they've been doing it without doing a whole dissertation on the Federal Reserve. But the question I'm asking is if inflation starts to come up, will they be able to keep cutting inflation or keep cutting rates? Excuse me. I don't think so. I don't think they will. If it goes up enough, inflation that is, will they have to start thinking about raising interest rates? That is definitely possible. And I think, me personally, the first time one of the board members of the Federal Reserve goes on TV and says, inflation's not where we want it to be, we're going to have to think about raising interest rates, if they use that term, the market is not going to like that. That is my opinion. The market will not like that. Now, that has not happened yet, by the way. So I'm speculating about the future. What has happened last week, actually, was one of the Fed board members did come out and say, hey, we might have to pause cutting rates. And I think that is a sign of what I'm speaking of starting to come to fruition here. But there is a world in which they have to start raising interest rates again because inflation's getting a little bit too hot. That would not be good for the markets. And if we get into a situation, this is the end of my story. Thank you for bearing with me. If we get into a situation where we feel like that is coming, that, hey, we're seeing the tea leaves here, we think interest rates are going to go up, we think there's other factors that are possibly negatively going to impact the market, we're heading to the tail end of this sugar high that we think is coming, or we're maybe just starting to get into, we will be sending out messages to you to say, not, hey, abandon ship, everybody take all your money out and put it into a bank because things are going to go bad. But we are going to be reaching out to pare back what you have in the markets because the markets are high, which is a good time to sell. You want to sell when they're high. But if we see these kind of storm clouds coalescing into a thunderstorm, maybe to make a metaphor out of it, that's when we will be reaching out to you to say, I think it's time we pull some money out of the market. Maybe not all of it. I don't like dealing in extremes like that unless something really extreme is happening, and I'm not necessarily predicting that. But I think it is fairly probable that at some point after tax season is done, maybe into the early summer, and I'm not going to pick a date for you because I'd just be making it up. But I think that window could see more volatility than we've had in the last year plus here, and maybe for a longer period of time. So what do we do about that then? And I'm going to get into more stuff about 2026 here in a second. But what do we do about that? Well, one, I think you wait until we see the signs of the thunderstorm. I don't think we bail out early unless we've got a really good reason to. Like you're saving up for a home purchase and you were going to take money out anyway, for sure, in the short term, right? I don't think anybody needs to bail out right now. But I do think we need to be ready to pull back a little bit as these wins kind of materialize here. So that is my story for the year, or at least the first half of the year. I think there is I'm trying to be very careful about my words. I think there is a good chance that there is a market sell-off in the first half of this year, probably after tax time. Okay. And I don't usually like to pin down a specific time period like that. I want to be clear. Totally an opinion, not, there is no guarantee. I could very well be wrong and the markets could be great. But even though I'm predicting that, I still don't think we should be making any moves with anybody unless there's a different reason until tax time is over and we start seeing some indications it could go that way. I'm not sitting here telling you this is what's going to happen, make our plans today. I'm waiting to see what the data comes in because there is a world in which inflation does not come in hotter than expected. And that's very possible. And if that doesn't happen, and maybe tax refund season won't quite be as big as the IRS is thinking. I think the IRS is right about it, but It's possible that could happen. So this is not a guarantee. This is not a done deal. Nothing I'm saying is for sure. Obviously, we're talking about the future here. But more than in the last few years, we're watching very closely for it, is what I want you to know. And we are somewhat concerned about, again, the storm, the clouds on the horizon here. Whether they come over us and drop rain, that's what we don't know yet. Again, sorry to be using so many metaphors, but that's kind of what it is. I'm not going to worry about this right now because I took enough time. Unemployment rate, we're looking at projections. Right now, the growth is projected to be low. Unemployment rate is projected to be steady. Those would be good things. I'd like growth to be a little bit better than that, actually. That's kind of on the low end of growth on this left side, this real GDP. Think of GDP as just how much the economy is growing. I could do a whole hour on GDP. But how much resilience is left in the U.S. consumer? I'm going quick through these because they're kind of telling the same story. Fairly good, fairly good. We have more disposable income than we did a year ago. Even though that line is sort of slanted down, that's just the percent change from a year prior. So it's going up by about 2% a year. That's good. And that's inflation adjusted, by the way. So even with inflation, we have about 2% more. And okay, I don't need to do a whole spiel on individuals versus aggregate, hopefully, but all these numbers I'm talking about are in the aggregate, are for all people on average. There are absolutely people who are struggling right now. I always like to mention that because I know if you know somebody like that, you're like, hey, that's great that that graph shows a nice number, Anthony, but I know somebody who's really struggling. Totally. This does not invalidate that at all. There are always going to be people, ideally there wouldn't be, but realistically there will be, who are on the poor end of the average. And we need to, that's a political thing. I'm talking about averages because that's what affects the economy as a whole. The last piece, and then we'll get to the forecast. Yeah. The last piece I want to talk about quickly is the Federal Reserve. Now, if you noticed earlier this month, I put out a note from us about the Federal Reserve because you may have heard that they're appointing or will be appointing shortly a new chairperson of the Federal Reserve. I forget what his name is. But he is obviously handpicked by the president. And in theory, that makes him potentially more likely to be sympathetic towards the president's views on what the Federal Reserve should do, which is that he thinks they should be cutting rates much more aggressively. I do not think they should be cutting rates more aggressively. I totally support what they have done. They've been cautious because if they cut rates even more aggressively than they have been, that's another pressure on inflation to make it go up. And we're already concerned about that. So I don't think they should do that. Now, the good news is, the silver lining is, the chairperson is one vote on the committee. And I believe the committee is 9 people. Ooh. I'll double check that real quick. The number doesn't really matter, but it's one of 9 people, or one of a good number of people. And the chairperson, despite the fact that they're the public facing role, they're the ones that go out and brief the media usually, they get one vote on what's going to happen. And if you noticed in that letter I sent out, and if you want another copy of it, we can get it to you. The other board members who are also get votes, their terms, other than one other person whose term is up in May, their terms are not up for years. In fact, half of them, their terms aren't even up until this administration will be out of office. I'm talking the 2030s here. And that's by design, by the way. They have long terms for exactly this reason, because the people who set up the Federal Reserve back in the 1800s knew that the politics of the moment would want friendly policy, right? They would want stimulus for the economy because that helps you win elections. That's exactly, this moment is exactly what the structure of the Federal Reserve was set up to tamp down. And it's working. It's working effectively to the point that I am telling you right now, as someone who watches the Fed very closely, I am not worried at this moment of the Federal Reserve turning into the stimulus bank of the White House. Okay? I'm not worried about the policy intentions of the Federal Reserve being corrupted beyond just based on policy. I don't want to be naive, for sure. And I'm not saying that there haven't been attempts to do that. There absolutely have. But so far, the institution itself has withstood them, and I anticipate that it will continue to do that. So, again, if people have questions about that, I could go into even more detail on it. But suffice it to say, the chairperson has one vote, and it is a democracy. It's not that they're what they say goes. It is a vote by the board members. And by the way, the other factor that is not, I think it's starting to be mentioned now. Jay Powell, who's the current chair, his term as board chair is what's coming up for his term is expiring, not his term on the board itself. Now, in the past, the board chair, when their term as chair is up, they tend to leave the board because they don't want to overshadow the new chair and make it seem like there's really a shadow chair, blah, 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 just for optics. I anticipate, I don't think he's announced one way or the other, but I anticipate he won't do that. I anticipate he will stick out his term, which I believe goes 1 or 2 more years here, and just be a regular board member to ensure that the policy does reflect the actual mandate of the Fed, not just what the president wants them to do. So I don't want to be naively optimistic, but I'm fairly optimistic about that. All right, let's get to the forecast. Now, this should be the most concerning slide that any of you see this whole time, and I say that a little bit facetiously. All the big banks that I said were wrong when they predicted their 2025 numbers, they're all predicting big growth for this year. And if there's one thing that makes me the most nervous out of anything we've looked at, it's this. Now, obviously, they're not all predicting the exact same number, but I just told you, and let me go back and I'll tell you again. Right now, the S&P 500 is at 68.67. So every single bank here is predicting a decent to strong amount of growth. That makes me nervous. And I'm a little facetious here, but it does. It does. When everybody's aligned that, hey, this is going to be a good year, get ready, buckle up. That makes me start looking for, why is everybody thinking that? And I know not everybody is. I've only got 6 banks up here, but that makes me start looking. Now, again, I don't necessarily think this is going to be a bad year. I don't want you to come away with that. I just think it's not going to be a straight year, and straight meaning straight up with growth. I think it's going to be a choppy year like that, or at least in the first part. The second part could be great, and I anticipate it will be. But no matter what kind of year it is, here's what I want you to know. If you are, let me see exactly. Yeah, if you're in the S&P 500, there has never been a 10-year period where the market has been down. Okay? Now, 10 years, I'll grant you, that's a long time. Only 7% of the time has there been a 5-year period which has been down. So in other words, you started and then 5 years later, it's lower than where you started the market was. And that usually happens when you center that end date right in the middle of a recession. So it's like you're cherry picking the worst time to do that comparison. Most of you, pretty much all of you on this call, are not 100% in the market. Some of you might be, but the majority of you aren't. This is only if you're in the market. If you take this and abstract it and say, well, what if I'm not all in the market? What if I'm some in bonds? What if I'm diversified? These numbers drop even further. And the point of this is, even though I just told you, hey, we might have a reason to pull back from the markets a little bit this year, that chart that I just had up is probably why I'll be telling you, yeah, I don't want to get all the way out of the market because you got to hedge your bets. You got to stay diversified. The value of being disciplined about this pays off over even relatively short periods of time. Certainly over the long run, the history says, but even short periods of time, it tends to pay off. There's a good bet there. So that's why I'm not ever going to be so hot or so cold where it's like we're all in the market or we're all out of the market. That's not how I think about it, and I don't think that's how you should think about it either. Steps for you to take. Number one, if something changes for you that materially affects not just your finances, but your life, your timeline, what you're going to be doing with money at some point, let us know. One, if something jumps out, we can maybe help or give you some good ideas of how to accomplish it. Two, it's just valuable for us to know what your timelines are like in all different aspects. Two, what are you concerned about? We want to hear it. I don't want you to sit there and say, well, now I know Anthony's opinion, so I'll just keep mine to myself and I'll let him do it. I mean, I appreciate that. I appreciate that you have that trust, and I think it's well placed. But I do want to hear what you're thinking because I might be able to, one, help address your concerns, or two, if it's like, Anthony, I get what you're saying, and I get that you're saying stay in for now, but I'm losing sleep at night. Okay, let's do something about that then. Let's see what we can do to make it so that, and hopefully you're not losing sleep, but if you are, that we can address that. So I want to hear that. And then make sure I could put this at the end of every slide we do. Make sure your essential documents are up to date. Steps for us to take: keep you informed, be regular communicators. Expect, I would say, to hear something from us in March or April. Maybe it'll just be, hey, everybody, it was better than we expected. Keep doing what you're doing. Then that would be great. I'd love it if that was the case. But if there's something we need to address, we will be getting in contact with you. We will make sure your investments are managed according to your needs. And then obviously we'll stay in the know. That's a number one. Again, next month is going to be all about the new tax rules. So really helpful one to listen to if you as you do your taxes this year, you'll see some of the impact, but there's even more stuff that's actually getting applied in 2026 and beyond. So that'll be a really good one to hit. All right. Well, thank you everybody so much. I hope it was a valuable time. I enjoyed talking through all this stuff. Again, this is kind of my bread and butter, and I will see you next month, if not sooner. Take care, everybody.